Welcome to this segment of GTM Training Shorts, presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what is SOX? Listen to Sunendra Miller, Director in our Wayne office, as she explains.
What is Sarbanes-Oxley, SOX, and what prompted the law? You might have heard of the Enron scandal from the early 2000s. Enron was an American energy company that declared bankruptcy in October of 2001. This was followed shortly thereafter by the WorldCom scandal. In both cases, the executives of these companies were able to use accounting loopholes and poor financial reporting to hide debt from the public. Both of these firms ended up filing bankruptcy. Enron's accounting firm was dissolved and the executives were sentenced to prison. As a result of these scandals, many new regulations and requirements were put into place to prevent these scandals from happening again. The most notable of this was the Sarbanes-Oxley SOX Act, which was signed into law in 2002. This law was spearheaded by Paul Sarbanes and Michael Oxley, and the goal of this was to protect investors by making certain disclosures more reliable and accurate. The SOX Act contains 11 elements. Let's discuss a few of the requirements under SOX. So the financial reports and statements have to certify that the documents have been reviewed by signing officers and passed internal controls within the last 90 days. Documents are free of untrue statements or misleading omissions, that the documents truthfully represent the company's financial health and position, and the documents have to be accompanied by a list of all deficiencies or changes in the internal controls or any information that might involve any kind of fraud by any company employees. The financial statements should also represent any material off-balance sheet items. Internal controls need to be a top-down assessment that's done in conjunction with external auditors. And external auditors must assess the internal controls and reporting procedures as a part of the audit process. The SOX Act created the Public Company Accounting Oversight Board, the PCAOB, which has oversight over the audits of many public companies. Prior to the SOX Act, a lot of this was just internally controlled. So you might see often in a tax department now under SOX that there are certain internal controls that have to be met. Work papers might have to be signed off by the preparer and the reviewer. There are certain meetings that must be held, as all of this is now governed by the PCAOB under the SOX Act.
For more information on internal controls and complying with the requirements under SOX, check out our Corporate Tax Provision Fundamentals program, scan the QR code, or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.